Welcome back, everyone, to the third and final session of the Working Capital Conference. I hope you've been enjoying this afternoon, and we're coming to a very interesting topic now when we talk about supply chain finance. And it's something that really has become even more topical, I think, during COVID, during the pandemic. So we've got two great panelists today that who are going to share their insights with you. I'll introduce them in a moment, but just to remind you, you've got a Q&A panel to the side of the presentation. So do put your questions in there, and you can start at any time during the discussion, and I'll bring them in as and when I am able. Don't forget the discussion group to network with others, to just develop a further conversation stream if you're really interested in the topic. And also remember that this is being recorded and will be available for 14 days after the event. So you can always come back to consolidate. Again, don't worry if you don't take note of every single thing. So also we'll be encouraging you, of course, to give your feedback on the session and on the conference as a whole. But without further ado, I'd like to introduce my two panelists. As you will have seen on the program, you'll have seen their bios, so I don't want to repeat all the information you already have, but I'd like to turn to each of them and ask, first of all, Julie Fabris, and then Mark Douglas, who is our sponsor for today, which we're very, very grateful to, of course. But I'd like them each to introduce themselves, say why they're passionate about this particular subject, and also maybe give us a little insight about them, an interesting fact that we might not have seen on their bios. So over to you, first of all, Julie.
Hi there, hi everyone. Yeah, my name is Julie Fabris. I've been a corporate treasurer for a number of years now, and a varied sort of career amongst sort of like various industries, etc. I've been with now Britax for just over 6 years. And Britax, they make and distribute children's car seats, for those of you who haven't heard of the name before. We're a sort of medium-sized business. Our turnover per annum is about 250 to 300 million pounds. But we are global, and we source globally, you know, quite a lot from China, Asia, but across Europe and the US as well. We introduced a supply chain finance program in 2019, so pre-COVID world. I'm quite passionate about it though, because I basically work with PrimeRevenue, but when we got it was hard work to get it up and running, but once it did get up and running, it proved such a valuable tool for us. And I was surprised at how easy it was once it was implemented. So I was pleasantly surprised, as it's a bit of a toolkit for treasurers. You know, we have working capital is obviously a key for us, being a manufacturer of car seats. And so we were looking to optimize our cash flow through the working capital. And yeah, so it'll be interesting to hear how the developments have been since then in the world of supply chain finance. One interesting fact, well, actually during lockdown, as I was turfing out a lot of my stuff, if you like, to go to various places, I came across a Rubik's Cube, which I do believe that I completed in 23 seconds back when I was a teenager. So I then tried to emulate that again recently, and sadly failed and couldn't even remember how to do it. So that's my little story of lockdown.
Oh, interesting. But enough, my daughter asked for, she's 21, and she asked for a Rubik's Cube for her Christmas present. It was like a blast from the past. Well, thank you very much, Julie, for that kind of context. And it's brilliant to hear that it's not so difficult to do, because we're all busy people, and anything that's efficient and easy for us, I think, is very, very appealing. But with that, I'll turn over to Mark and ask you to introduce yourself.
Sure. So thank you very much, Caroline. Nice to meet everyone. It's Mark Douglas here from PrimeRevenue. I've been with PrimeRevenue now for about 4 years. Previous to that, I was at Investec, and I was involved in the corporate treasury sales team there. So I've kind of spent my career in banking prior to PrimeRevenue, always facing off to treasurers, more focused on risk management. Took a bit of a left turn to come to PrimeRevenue because I just like the idea of talking to similar people about a different problem. So I've got immersed in the world of working capital improvement, and that has evolved over the last 4 years. It's been a very interesting journey for me. Yeah, I have become quite passionate about this, and the last 12 months have been for me quite fascinating, just to see what's happened in a very, very unusual, unprecedented environment. I'm a kind of a warrior of money markets and FX desks from the financial crisis, but that was again a very different scenario, I believe, to what we have now. So yeah, looking forward to having a discussion about the PrimeRevenue. Not so much about PrimeRevenue, guys. I'm not going to be pitching anything. Don't worry. Just keen to take my sales hat off, if you like, and just talk about the market and what we're seeing, what we think the opportunities are, and hopefully, pose some interesting questions for you guys to go away with. Interesting fact about me, I think, like everyone, I'm kind of battling probably with my mental health on a daily basis in terms of lockdown. But I had an enormously exciting delivery this week, which was a standy up desk. So I don't know if you can see, it moves, and this was a real highlight for me for the week, and it's about as interesting as it's got so far. So I'm sure this session will up the ante again. So thank you for tuning in so far, and I hope you're still here at the end.
Thanks very much, Mark. And I think we can all empathise with how you're feeling. And also we have pre-records that are on the kind of softer skills that people can access on demand on this platform, also for the next 2 weeks. So please do look at those and other materials, because looking after your own well-being is really important. And I've also been thinking about that standy up your desk type idea, so I might have to pick your brains afterwards. But great to have that context, and great also that you've joined us. And as you say, this isn't about sales pitch, it's about thought leadership and sharing. So I'm going to stay with you, if I may, and just ask you a little bit. It's been interesting times, as you say, but what have you seen in terms of supply chain finance? What is going on out there at the moment? Have you seen an acceleration in activity? And is it something for all organizations or only some?
Sure. So I think I'll start with the first point, which is what's been going on. I'd say I'll try and kind of summarize, in I think 4 observations. So I think observation 1 is that our existing clients have been very active in the last 12 months with their supply chain finance programs, but it's not been, I think, what people would traditionally associate supply chain finance with. It's not been driven by an ambition by our buyer clients, so to improve their own working capital. I'd say by and large, that objective has been pretty much put on hold, and the priority has been to secure up supply chains and inject liquidity into supply chains as much as possible. So we've been busy, but not in that traditional sense of trying to find that win-win where buyers want to, pay later, and in doing that they see a significant improvement in their balance sheet. But supply chain finance is that I guess antidote to that, in that a supplier then gets to get paid whenever they like. And also then there's a working capital benefit to the supplier. So this notion of win-win. So we've seen a definite change in the use of supply chain finance. The priority, I think, rather than a nice soft side, has been to look after supply chains, which for us has been quite heartening to see how people have behaved. So what have we seen our clients been doing? So just to kind of reiterate that point, we have not seen clients rush to their supply chains, and we've not seen clients paying later. We've not seen clients looking to extend payment terms to shore up their balance sheets. But we have seen significant activity in the capital markets, and particularly debt capital markets, and there's been no shortage of, I think, for the right credits, which I think is particularly unusual about this crisis. What we've seen is banks have taken a view, and I think the debt capital markets seem to have taken a view that good business going into this crisis will be supported, and there's appetite for those credits, and that's been the go-to for businesses looking to shore up their balance sheet. It's been debt capital markets, the bond market has been highly active, and then government support. I think I'm less familiar with other parts of the world, but particularly in the UK, government support has been quite resolute. I'm an investor in a small business, and that business has been able to tap into incredible levels of support on incredibly attractive terms. So I think the government support scheme, which is based on this idea of banks lending with a guarantee, has been very successful, and we've seen, businesses really just max out on liquidity, which I'm sure will be a familiar story for some of you kind of managing balance sheets. So I think the third observation is that we've initiated a lot of COVID-related programs and expansions, and really pushed down further into the supply chain with some customers than we have done before. But the interesting thing is the actual take up of that has been quite lukewarm for 2020. So I think we're certainly hoping that we would be really filling a gap in terms of short-term working capital for suppliers. But I think what we're seeing is that actually suppliers have managed to tap into other means of funding, particularly government funding, which has meant that their balance sheets have been fairly firm, obviously depending on sectors. That was an interesting observation for us, because both our clients and us thought, we need to do something, but the take up in reality was actually quite lukewarm. Saying that, January and December, we've really started to see those projects which we kind of left, to be frank, because we didn't see a lot of take up, have really started to pick up. So I think businesses now going to 2021 are looking, okay, right, what's my medium-term plan here? Getting paid early is a priority, and we're actually seeing quite a significant move now into those from suppliers into those programs which were offered earlier on in the year. They're coming back quite significantly, which I think is an interesting leading indicator for 2021 and people's outlook.
Mm-hmm.
And finally, I think supply chain finance in itself isn't a financing tool. The benefit is derived for buyers from extending the payment terms and the impacts on your cash position and your trade payables. But obviously, there's financing to support suppliers if they do wish to get paid early. The pricing on that and the liquidity availability on that has been remarkably stable this year, which has been another observation, is that I'd say the product is not new. There's lots of new entrants, but the product is not new, and it's actually we've seen it behave remarkably robustly, despite a severe shock, and we haven't had any major issues with liquidity on any of our programs as a consequence.
Really interesting.
A couple of us.
Well, thank you very much.
So that's
Mark. Yeah, well, thank you for that overview. And it is interesting, isn't it, maybe what expectations we had and what's actually happened. And you also mentioned about collaboration and a kind of solidarity amongst people in this profession, shall we say so. And that's something we see maybe we'll be able to come back to later. But I'd like to move to... Sorry, you got another point, Mark?
Yeah, sure.
Go ahead.
No, the last thing in terms of size, like the question around size.
Yeah.
So I think what we've seen is leading into 2018 and 2019, this market was definitely pushing down the credit spectrum. I think, and then materially moving down the credit spectrum, and the vast majority of our deals were sub-investment grade companies in 2018, 2019. 2020, that market for new deals is pretty much closed globally. There's not a lot, bar one deal this year. We've done nothing which would say is kind of below double B in credit. The investment grade has had virtually zero impact in both pricing and liquidity availability. Double B, which would usually be a sure thing, we wouldn't have to worry about whether or not we could fund a program. Double B, we've had to take nothing for granted, and that's, I'd say, liquidity is definitely shortened up in that market. And I think just a question to ask people, if you are thinking about this, is can you raise unsecured credit at the moment? If you can do that, and that's part of your toolkit, then it may be a conversation to have. I think if that's closed to you at the moment, and chances are SCF, which sits in the same place in the capital structure, will be closed to you too.
Thank you. Thanks very much, Mark, again for all that. A wealth of insights there. We're going to move more operationally into the detail now with Julie, if we may. And just to ask you, Julie, a little bit, tell us a little bit more from more practical aspects, you know, how to go about setting it up in the first place, what you need to be aware of. And there's a couple of questions coming in that you might like to cover off, because one of them is about, you know, do you have to move all your suppliers into the programme, or can you pick and choose, and what are the issues? So if you wouldn't mind incorporating a response to that one in your general response, that would be brilliant.
Yeah, sure, Caroline. I mean, the Mark touched on the credit point of view. So just to take a step back a little bit, where Britax are, we're a private equity owned business, or we were different shareholders back then, and our credit scoring was pretty low with our banks because of the high leverage debt that we had. And when we initially looked at, you know, supply chain financing, again, it's not so much what Mark is seeing now, but ours was a sort of a cash flow driven mechanism for improving our cash flow at the time. That was how we wanted the result to be, but using a win-win scenario with the suppliers as well. So, you know, choosing those strategic suppliers. We were able to gain support from our shareholder at the time, and an influence from their relationship bank in order to provide the funding. So I just wanted to sort of say that credit now, and that credit line is not infinite. There is a finite amount, and what we needed to do was, when we were looking at the suppliers, is you have to model out what volumes of trading they are likely to do on the platform, because if you have too many suppliers on there that trade all at once in one go, then you're going to reach a limit to your credit. Well, we were looking at that scenario anyway, and we were a bit fearful, the fact that we had a take up of too much volume, if you like, that we were going to get to a stage where the supplier wanted to trade and get their money early, and they couldn't because the banks had reached the credit limit. So I just wanted to tie in that sort of side of things. But when we're looking at these suppliers from Britax's point of view, we were able to pinpoint the key strategic long-term relationship suppliers, and provided the big volume for us, because that was giving us our big win. Now, I'm not saying that that is something maybe corporates are looking at nowadays when they want to help the liquidity in a COVID pandemic environment. So it might be very different in choosing your suppliers now, but our criteria at the time was to look at those suppliers that were key to us long term. A lot of these suppliers we've been in relationships with for sort of like 15, nearly 20 years, you know, and also the key internal strategy is really, as a corporate treasurer, you need to hook up with your purchasing and sourcing team very closely, because they change sourcing, they change suppliers, you know, things are ever evolving. There's no point in hooking up a supplier that 6 months down the line, the supply, you know, your purchasing team have decided they don't want to use them anymore for whatever other reason, because, you know, the negotiation, the relationship with those suppliers sits predominantly with the purchasing team. So in terms of the operational, the internal aspect of it, it's very much, you know, you need to be coordinated with the purchasing teams when you go into this project. You need to get buy-in from the purchasing teams, who, you know, have their own sort of like maybe different agendas in terms of negotiation. It may not be payment terms, you know, they have a whole heap of other things they put in the mix there. So before anyone sort of like embarks on looking at supply chain finance, very much the look at the working capital, look at your creditors profile, look at get some advice, legal advice, as well as, you know, tax and accounting considerations. There's a legal consideration, especially for us, because we had debt agreements in place. So having another sort of credit line, you need to make sure you're in compliance with your existing debt instruments. Auditors, it's worthwhile actually just getting them involved up front as well, so that they're understanding, if you're embarking on this program, how it is going to be reflected, and there's no issues there. And then, you know, in terms of as I say, it's not really, the implementation is hard, but once you get going, I think it's quite easy to keep running. The process itself is very easy to keep running, but the implementation is hard. The way that we did it, we had training workshops internally with our purchasing teams. We hooked in sort of PrimeRevenue at the time as well, because they could then help with a presentation to our suppliers. I was absolutely quite amazed with the purchasing teams themselves, because you sort of say, okay, well, we're looking to extend payment terms, and they'll shake their head at you. No, they're not going to buy that. And yeah, at the end of the day, they did, and they bit more. So, and the purchasing teams back said, wow, and the penny dropped with them after these training workshops. So internal training workshops, singling out the suppliers as well. There's quite a lot of upfront work in terms of modelling, looking at suppliers, like I say, modelling the volumes out, modelling the cash flow, potential cash flow benefits in terms of your working capital. That was something that quite a cold towel over the head type scenario, when you sort of like, you're trying to actually, because, to get your board support, you need to sort of demonstrate, or what's going to happen if suppliers trade everything up front, trade, I don't know, after 20 days, 30 days, or they don't trade at all. And we had some suppliers who didn't trade on the platform. So we took the cash flow benefit, and that was fine, So it's modelling out those scenarios and being able to demonstrate to the board and track the board on the progress. In the end, we had we had 27 individual sort of meetings with suppliers with a presentation. We did a sort of round robin trip. I brought the CFO along as well. So the CFO very much was backing this project. So board backing is very important. And that comes back to sort of like, the internal structure of an organization. It may be that, you don't have that much influence over the purchasing teams from a finance perspective, where the board will. So, if you get that backing from the board, then that really helps. So yes, and also when you're meeting with suppliers, you would have your key relationship people that talk day to day from the purchasing teams on both sides. But it's very important to get the suppliers' finance teams, the relevant person, whether it be their treasurer or whatever, in the meeting as well, so that they can understand the financial aspect of what's being sold really to them, and understand that the win-win situation does really work. As we went through this process, I was surprised as well by some of the answers. I mean, the suppliers have different reasons for taking up the supply chain finance portal. One of the surprises was I didn't realise, but one of our suppliers pays for credit insurance on us and has a huge exposure and debtor on their balance sheet. And for them, their motive was actually to receive the cash early, but the cost of receiving that cash, they weighed up against the cost of getting credit insurance. So that was really interesting. I didn't really pick up on before, because I was thinking, well, suppliers, they'll want the cash for whatever reasons, the visibility, the flexibility and everything else. But the credit insurance angle is an interesting one. So each of the suppliers you then, and what that does is it then starts a different relationship with the suppliers. And to my mind, I think it forges a better relationship. We also, because of the credit limit as well, we went to the suppliers sort of saying, well, actually, you've been, I know this sounds a bit cringy, but you've been chosen. We want to do this program and we want you in it. We want to help you. And we want to bring you in, but there is a finite level, so sort of an incentive to again forge that long-term relationship. You're a strategic supplier of us. We want to work with you going forward. So yeah, so that was that. I think all in all, from start to finish, I think it was about 4 months, wasn't it, Mark? I think there were, yeah. The other thing that, when you're looking at your working capital, you're looking at supply chain financing possibilities. Not only the likes of PrimeRevenue are there as a sort of like a mechanism for getting funders for you, so it's quite flexible. You should talk to your banks. I think relationship banking is quite important in terms of the credit angle that Mark was talking about. So if you don't have such a good credit, your relationship banks are the ones you want to kind of like talk to first. You may find that they actually supply such a product themselves, a supply chain financing product themselves. I would question whether singular bank funding is the best option, and are they experts in that field, as opposed to sort of like people like PrimeRevenue who have the, you know, who basically are experts in the field of supply chain financing, but not in, you know, will find funders. But you see banks themselves may want to sell you their own product. I don't know, but it's definitely worthwhile benchmarking and exploring that as well. So, so 4 months in all, as I say, 27 supplier meetings. I think about half take up, 11 or 12 took up them. And the other thing, sorry, I was bringing back to the banks as well, is that the funder needs to make sure they have the coverage in the area that you're operating in as well. So, you know, we came across a problem because the bank who were put on the platform didn't really have knowledge of China and Asia suppliers, especially China, and operating in China. If you want to go to China for the supply chain finance program, then you need to make sure the funders are covered in the areas that you want to look at.
Yeah.
So.
Just on that last point, Julie, one of the questions that has come in, thank you audience, keep those questions coming in. We've got quite a few here already, but there's room for a few more. If you'd like to, we can always divert to the questions instead of what we've got pre-prepared. This one is, how do you cover all suppliers, not just the ones your lead bank wants to cover? So it's a slight nuance on what you've just been saying. I just wondered if you had a thought on that one, Julie.
So sorry, repeat that. So that was saying what?
How do you cover all suppliers, not just the ones your lead bank wants to cover?
Well, it's not a bank decision at the end of the day, though, is it? I mean, you know, it's you as a corporate, and I think it's you picking out those suppliers, like I say, that are strategic to you, that you want to help and forge a stronger relationship through going forward. And it may mean, I know that companies have different sort of aspects of it. Certainly isn't a bank that's driving this decision at all. And a funder to the program, Mark, correct me if I'm wrong, but you know, if a funder comes in, does a funder have a sway in which suppliers can join the platform or not? I think it only comes down to anti-money laundering. I think it just comes down to KYC checks that banks need to be comfortable with, but ultimately it doesn't matter on the supplier,
right.
does it?
No, the funder needs to, again, I'll only speak for how we operate, because we operate with multiple banks, and that gives us, and more importantly, it gives our customers leverage with those banks, because if you are a strong enough credit, you'll typically have more liquidity available than you need. The way that plays out is that there is no wiggle room for a bank to pick and choose suppliers, because the limit is agreed, the parameters under which invoices can be traded are agreed in terms of size of invoice, etc. And then it's just traded very agnostically up to that limit once the supplier has been approved from a KYC perspective. But the supplier can only be not approved if they don't pass KYC. There's no other parameters in which that's allowed, and that's all agreed up front. The question is correct. I mean, single bank programs do, one of the things you'll hear about single bank programs, and we hear from our customers, and is that you do have that issue. You do have banks picking and choosing which suppliers they want, because they want the big ones, and then everything else typically will go by the by. Not always the case, but that's one of the main negative stories we hear, which will play us into an opportunity. Okay.
So the advantage of using this kind of platform is that you won't have that kind of issue, which I guess is reassuring to the person who posed that question. Also, maybe if I just pause as well, there's a few questions around money, which is not surprising, as we've got an audience of treasurers. One is asking, is supply chain finance expensive? And what finance and non-financial considerations should I apply when thinking about establishing a program? And Julie, I think you've covered off a lot of the non-financial considerations in there. And then there's another question, that someone ultimately bears the additional cost of supply chain, often the customer, and how has pricing changed over the last few years, and will it increase in 2021? So really about the money side of things. Maybe, I don't know if you'd like to start us off, Julie, and then we'll move over to Mark to get his insights.
Yeah, I mean, I can't speak for Britax personally in the market because our supply chain finance portal has changed somewhat. I think when we initiated the programme, though, the funder would come in with a rate that would be the funding rate, and then a small admin charge on top. And yes, it's borne by the customer. But what you're trying to do, it comes down to sort of like your credit, your individual sort of like credit score, and how much you can then, you know, pass that on to how much you need to pass on to the customer. And you want to do it in a fair way, really, so that, you know, I was on the receiving end of the supply chain financing program as a supplier back when I was working for Bird's Eye Foods, and I was extremely skeptical when I had a letter come through from a customer saying, well, actually, we're extending our payment terms, but we're extending our payment terms full stop, but you can have the same payment terms by joining our portal at a cost. And I was like, well, that's just wrong. You know, that's just totally the wrong way and the wrong approach in my view. You know, you need to be able to demonstrate, it needs to be a win-win, I think, as Mark said before, you know, with both. But yeah, so in terms of where pricing's going though, I mean, we had our price fixed at the time. And it didn't really change that much. It was sort of like a floating rate LIBOR plus a margin. Mark, you're probably much better placed to talk about sort of where pricing is going, aren't you? I think in the general market.
So obviously there's winners and losers from the last 12 months. If you're in food retail, you're probably in a better position. You know, if you're in logistics like DHL or Deutsche Post DHL, for example, you're in a good position. But I think, look, in terms of a guide, a rough guide, typically you'll see a comparison, a similar comparison to your RCF. So if you've got an RCF in place, similar dynamics are in play. So an RCF, if it's a secured RCF, it's committed. So the security brings the price down, but the commitment brings it up. And it's the opposite dynamic of supply chain finance. So it will need to be unsecured because it needs to sit in the capital structure in the same place as your trade payables. But the limit will also be uncommitted, and it's that because it's uncommitted, the capital treatment of that money is significantly different to committed facility. So what you lose in the kind of the risk premium on an unsecured piece, you massively get back in the fact that it's uncommitted. And I think the difference is banks hate writing, well, you know, banks are loath to write RCFs which don't get utilized because it costs a fortune because you have to put aside the commitment for the entire limit. With supply chain finance, you're only really putting aside capital for what's utilized. And banks are very adept at bringing that capital charge down on uncommitted, depending where they are. So mainland Europe banks are very, very good at getting their capital right, particularly Dutch banks, French banks, UK lagging a bit behind, I'm sorry to say, but starting to make improvements. But really, so I would say your RCF is a good comparison of where you might be. But the rationale behind that is that it's an uncommitted source of financing, and it's also unsecured. But the capital treatment makes it extremely attractive. So you will, if banks have appetite for your balance sheet, then you'll have a certain element of influence on where that price sits because there's high demand for it. Think of it like it's a short-term revolving credit risk, which actually in reality is a very, very long-term revenue stream. So that dynamic makes it very attractive to banks.
Mm-hmm. Yeah, sure. Thank you very much. We've got quite a few questions here, and one's quite an intriguing one. This one says, how do you get the balance right between doing the right thing, quote unquote, and protecting your liquidity? You'll get fired by your boss and feel anxious about only one of these outcomes. Mark, have you got any thoughts on that one?
I don't think doing the right thing and managing liquidity, I think it really depends on the business. So doing the right thing can sometimes be managing your liquidity. So, well, we often will be managing liquidity, and you've got to be, you know, I think trying I think so. What I think that is going is, I think, doing the right thing and then potentially offering liquidity into your supply chain. I mean, if that's at the detriment of the stability of your business, then I'd say it's probably a pretty bad idea. But if you have banks eager to lend, eager to look for ancillary business, then looking for ways to push that liquidity down into your supply chain can be a very sensible way forward. But this is not a product of last resort for anyone. It's your suppliers or for yourself, and you won't get deals away in that scenario. We have the majority of our inquiries, inbound inquiries, are businesses looking for cash. Because if you Google, "I'm looking for cash," then we might come up in Google. We've tried to stop that, because it's you tend to attract the wrong sorts. But I'd say, yeah, I mean, that's probably a bit of a wishy-washy answer, but I think it really depends on your business. And I would never advocate. So with my risk management hat on, you look after your own shop first, and then if you can help others, then you do.
I think both of the other questions that we've got still pending in here actually touch on the same topic, because one is saying, have you seen instances of organizations higher up in the food chain, so to speak, supporting others with supply chain finance, or even if they couldn't do much themselves, trying to help others, because we've heard a few stories around that ourselves at the ACT. And then another question says, in the dash for cash last year, do we know if companies deliberately paid suppliers late to preserve their own cash and to manage credit risk exposures? And was it a bigger issue for smaller companies? So I think there is obviously in the audience some general concern about people trying to protect their own organization, and then it having consequences for others in the ecosystem. But then there's also this other story about everyone in the ecosystem being very aware of the interconnection, and if you don't get your supplies at the end of the day because somebody's gone out of business, then you're in a bit of trouble. So I think the whole principle we're talking about here is really about win-win solutions. But just Mark, maybe before we go over to Julie again, maybe any comments on what you're seeing in terms of those good news, positive stories, and those rather more negative that are maybe being suggested by a couple of our audience.
Yeah, I mean, so I'd say that we've got a range of supply. We've got a range of customers, right? Depending where they are in the world. Our European customers are typically much less aggressive than our American ones, which you'd probably expect. But I mean, supply chain finance is designed to try and eradicate things like payment stops, because you're adjusting your payment terms to make sure that you're always comfortable paying on that date. I'm sure, I've no doubt there'll be plenty of stories about people instigating payment stops over year ends and quarterly this year. But in our customer base in certainly the UK and in Europe, we've actually seen the opposite. To be fair, we've seen, I alluded to it earlier, but we've seen the opposite. There has been, I think, and again, probably for selfish reasons to an extent, there has been a genuine concern about liquidity in supply chains and keeping supply chains moving, particularly for food. And I would say that's been more. We've seen more positive behaviours than negative, but I have no doubt there'll be industries who have been messing around.
I think it's been very unusual times, hasn't it, as well? I think there has been a certain sense of solidarity across the piece, everyone appreciating that everyone's in the same boat. I'll turn back to Julie now, though, because I'd love to ask you a little bit about whether you've seen any of those kinds of situations going on out there, but also just generally whether you have seen a changing attitude towards supply chain finance over time.
Yeah, I mean, so beginning of last year, when it was all taking off in China, and I think, we got wind the fact that the supply chain finance was going to get squeezed. Everyone's going to run for liquidity and everything else. And as Mark says, we didn't see that either. We didn't need to stretch our payment terms and our supplier payments. We were sort of like more concerned as a business in terms of our receivables book at the time, and so so we sort of concentrated our efforts on that. I think suppliers Again, the ones that have been around for 15, 20 years, strategic long-term suppliers, we didn't really foresee too much of a problem. I think a couple of them were a bit wobbly in terms of their financial structure, but as Mark said, it's about helping them, and assessing where we are, where they are, and getting together and improving our relationship, working it through together. And I think that's what we aim to do. And we also found on our receivables book that there wasn't actually a problem. Now, again, as mentioned before, it could be because of the huge government support that's been pumped in to help certain industries. I wonder whether that honeymoon period is going to come to some sort of fruition. But I think if you're in the right industry and you're resilient to recession, you've got a stronger balance sheet, I don't see that's going to be too much of a problem. But yeah, again, I just sort of say what's been said before. I think we certainly, in our experience, we didn't see that pressure so much. The supply chain finance route for us changed a little bit. Britax became under new ownership beginning of last year, actually. And at that time, we then moved away from our existing shareholder support and we went self-funding on the portal, which was an interesting angle. Just want to touch base on that a little bit. So our new shareholders were able to help fund to keep the supply chain finance program going, because at the time they wanted to make sure that our suppliers were not disrupted through the restructuring, which was interesting and good, and helped a lot for the business. So we actually, we became self-funding on the platform, which is something you can do because with PrimeRevenue, they have the flexibility. You can bring in different funders, and at the end of the day, you can also fund yourself. So that's what we ended up doing.
Great, really fascinating insight there. Thank you so much, Julie. I just want to move on. We talked quite a bit about the supplier relationship and how things have been changing over time and all that. But there's another very, very big topic out there that people may not have connected, particularly with supply chain finance, and that, of course, is ESG. And even some of what we've talked about fits a little bit into some of those categories. But I wonder if, Mark, I could turn to you to expand a little bit more and maybe talk about this hot topic and how it actually applies to supply chain finance.
Yeah, it is a hot topic. I've really tried to steer clear of ESG certainly for the first 6 months of this year, to the extent that there's a lot of noise, and I was very cautious that as an organisation we didn't just start making noise about something we didn't really understand, but importantly weren't sure where we would potentially fit. So I've been a kind of a chief cynic in terms of PrimeRevenue's involvement in ESG. But over the last probably 3 to 6 months, I'm now the most annoying person in PrimeRevenue when it comes to talking about ESG, because I don't stop talking about it. But we're trying to develop a point of view on how someone like PrimeRevenue can help, but also just what role, whether it's us or anyone, what role can supply chain finance play with a business when you're thinking about ESG and how that ratings criteria can be impacted for the better. We frame it in 3 ways. It's very similar, kind of a slightly plagiarized, bastardized version of the emissions scoping. We look at scope 1 for us is the rated company. So what can we do to help our clients with their own rating? Scope 2 is downstream, so looking at the supply chain. How can our clients influence their supply chain's ESG scoring, which is probably where we're most excited about and feel we have a role to play. And scope 3, which is not really on our agenda for the moment, is upstream of the rated business, which is obviously customers. And we don't feel we've got a relevant role to play in that at the moment. But scope 1 and 2, scope 1 we already do the COVID examples are good examples of that. Well, I think what's interesting about that whole experience is it's now, I think, brought to life the value of support in the supply chain, the value of injecting liquidity into the supply chain for its own sake. But actually, when you look at that with an ESG lens on, and you're talking about your social impact and how you influence the people you work with, we think there's a very viable way for people to, by pushing this product further into their supply chains, to offer support, which will mean something from an ESG perspective. And then in terms of supply chain, sorry, go on.
Go ahead.
Yeah, in terms of supply chain and that scope 2, we think there's a problem to solve there potentially, which is that buyers want to do something, don't know what to do. Suppliers are probably are getting bombarded with things they need to do constantly, and then you have rating agencies, so EcoVadis, Sustainalytics, these guys who want to do things at scale but don't have the expertise to kind of run a change management process at scale. And you have funders and banks who are desperate to deploy green funding into somewhere, again, aren't quite sure what to do. So we think there's a potential to sit in the middle there. And I think the exciting thing probably for the next 5 years is looking at that scope 2, and it not just being a nice to have experiment. You could potentially do something very material in your supply chain.
Yeah.
And that's what we're focused on. And I think the question I would ask to people, where are you in that ESG journey? Are you super involved as a treasurer? Is it a team that do it by themselves? Is there an ESG team you have nothing to do with? And I'd say treasury, we have treasurers in our client base who are super involved, leading committees to don't know at all. So
absolutely,
I'd say think about that and ask that question: where are you as a business in that journey, and where are you as a treasurer in terms of involvement?
Indeed, as you say, that the nature of the beast, if you like, is very, very firmly around that S, the social. But there are opportunities to kind of to accelerate that E as well. So really interesting topic. Maybe we can be cheeky and turn to Julie and say, as a treasurer, where are you on the journey? Are you fully bought in? Is this something your board talks about, that you're passionate about? Is it something that you've really been trying to keep away from as long as possible, somewhere in between?
Well, how can I put it? I think actually in terms of our journey, we're at the sort of like at the early stages, I would say. I think there is the management, senior management, and the internal purchasing teams. I know that the decision making nowadays around where to manufacture products is a lot more in terms of looking at the social aspect, but it's the measurement of that I think we're struggling with a little bit, is actually how to quantify that, how to measure apples with apples, when you're making those sorts of decisions about where to source the product from, for example. With supply chain financing, I see at the end of the day can help with that, and ultimately charge a different price to your suppliers that are complying versus those that aren't complying, I guess, in its simplest term. If I was completely honest with you, I am not an expert in it, nor have I been involved significantly with the journey that the company's going through. I hope to be, trying to be, but it's early stages for us as a company, I think. Yeah.
Well, thanks for that honest answer, Julian. I think it's a lot of our treasurers, remember when we started talking about ESG a few years back, we could hardly get any traction with anyone, and now it's becoming more and more popular, and I think rightly so, and accelerated through COVID. But when you've got a tiny team and you're flat out doing so many other things, I think at first it was kind of like another thing for me to deal with, but now it's starting to become much more mainstream, which is so really interesting times. I think also at the outset of COVID, I think a lot of people thought it would be put on the back burner. And
yes, actually, I think, yeah. And then the resource and priorities, like you say, I mean, we went through a restructuring, refinancing, and then came out the other end into COVID. So, it's been pretty busy the past 12, 18 months. So.
Absolutely. I can imagine. I feel for you. I've got a couple more quick questions, and then I'd like to round up getting your kind of final thoughts, if I may. There's a question for you, Julie, here. Are there any customers that didn't get supply chain finance, and why? Who and why? I don't know if you can answer that. But
that wanted to be on board. There were some that declined. Some that had their own invoice discounting in place and therefore thought that, you know, it couldn't complement it, even though we were trying to sort of convince them that actually you could. Yeah, so that was some of the people that the suppliers that turned it down. The other one is bizarrely the KYC, China. You know, it was a little bit difficult to get that past the funder at the end of the day. So, but actually, having said that, I say the one good thing that came out of it from us, Britax, I think I go back to saying that at the time it's different, would be a different approach now, but at the time it was to do with sort of like the win-win and cash flow extending payment terms for us. And what we found is those suppliers that appreciated us coming and getting in front of them, presenting the solution rather than just ask for extended payment, gave it to us. So we didn't really need them on the platform anyway. So they were quite happy. So yeah, that's a win-win for Britax, I think. But, you know, so yeah.
It can't have harmed all that kind of building relationships and giving your suppliers attention. You know, it sounds a very, very good approach. The other question that I've got pending here, maybe Mark, I could turn to you. It's how will the changing benchmark rates away from LIBOR change the discounting platform?
So this is another. I have a call on this every 2 weeks, and it's a not very exciting call. So for us, there will definitely be changes, but it's more a transitional change than anything else. So in terms of our platform, we have inputs, we have input rates. So if it's not going to be, when LIBOR's replaced, there's an input rate that will go in. That's updated every day by the funding bank. So that doesn't. But the challenge you have is that this is a roll. This isn't going to all happen all at once. We're going to have we have customers who are in every continent. You know, may have 27 to 20, you know, to 30 odd buying entities within that company, and they'll be dealing with, you know, some of our clients have 12 banks on the program, and all those banks are transitioning at different times depending what country they're in. In the US is super complicated in terms of how that will take place. UK seems to be ahead of the curve on that in terms of the process, but the complication for us is just managing that transition. The fact we're going to have LIBOR, SONIA, everything you can imagine is all going to be on the platform all at once for a period of time, and that's going to be the challenge, just to make sure that we're compliant and that's all working accurately. But I mean, we get to be the middleman in that, and kind of the onus and the responsibility for that lies with banks. We will just take an input price, but that will get complicated. And there's a couple of other details which mean we have to display more things to the supplier. There's more transparency requirements. Mm-hmm. There's going to be additional credit spread, etc. But yeah, by and large, it's going to be probably a messy few months as we manage through that transition. But after that, it's just an input.
Thanks very much for that. Another question is, I think I can just squeeze this one in if we get a quick answer on this one. What has been the impact on DPO KPIs, if any? Either of you like to take that?
Well, Julie.
Yeah, I mean, our DPO, we managed to extend from 60 days to over 100 days overall. Yeah. So yeah, that was the that was the goal, the aim, and that's what we kind of achieved. So yeah, we generated about 20 million euros worth of cash flow in our creditors line, negative working capital from that scenario, but with the proviso that the suppliers were happy to join, and they were, you know, because they could see the benefit. We got an attractive rate in the end that we were able to pass on to them. So definitely the KPI. Yeah, I'm saying.
Fantastic. Now, just in closing, I'd like to ask you each what's your kind of one message on the topic of supply chain finance would be for our audience today? Anything that you'd like to get off your chest, share that we haven't had a chance to yet, or a summary of your kind of feeling on the topic? So, Julie, could I ask you to go first?
Yeah, I mean, I would sum it up by asking sort of corporate treasurers to be brave. All right, don't shy away from supply chain finance as a tool to help you in your financing solutions. I think, you know, with the backing of the board, yeah, it's a hard to influence, let's say, other people in your organization, your purchasing team, but getting them on board will reap benefits. And whilst it's a hard sell sometimes, maybe from treasurers who, you know, purchasing teams may not want to, because they have their own agendas that may not be the same, and convincing them is hard. So you've got to come out of your sort of comfort zone around sort of like just looking at finance by going into the organization and looking at the, you know, the suppliers and the volumes and the purchasing. It's hard to implement, but I say once it's up and running, it's a very smooth process. And the other point to say is that, you know, I was a bit fearful because you think that once you're in this cycle of supply chain financing, you can't get out, which is totally untrue. So, you know, you might think, well, actually, this is a one-way street and I'll never be able to get to you know, extinguish it if for whatever reason that you want to. But that's simply not true. It's flexible enough.
Thank you very much. Mark.
Yeah, I think it's a similar theme, really. I think if you're successful with supply chain finance, you get an incredibly efficient source of capital. It's not debt. You know, you've made an adjustment to the dynamics of your balance sheet, and the financing in the background is there for your suppliers. And that's not what you directly benefit from. You would benefit from the movement in terms, if that's the goal. But as Julie said, I think it's something to go with your eyes open. It's not a flip the switch, you know, type tool. It takes focus, it takes commitment, and that's across the company as well. You know, finance, treasury, and procurement have to work really well together. IT need to be involved, but Julie's talked about all the soft benefits you get from that. But yeah, go into it with your eyes open, and that it's hard work, but what you get at the end of it is probably can be worthwhile, and it should be material, right? The goal that you have in mind, whether it's, you know, to secure your supply chain, to inject liquidity into your supply chain, whether it's a working capital goal, it needs to be material, and it needs to get the attention of your CFO, and it needs to play a meaningful part. Otherwise, it's not worth it. I think where supply chain finance has gone wrong in the past, certainly with single banks, it's been because it's just been a sandbox experiment. Have a go and see how you go, and that will always leave a bad taste in everyone's mouth.
Absolutely. Well, really great insights from both of you there. I've learned a lot today. I think there's some surprises for us all in there, maybe not what we had expected entirely. So really, really great. Thank you both. It's been a pleasure having you in this discussion. A few people to thank before we close today, but just a reminder, first of all, to the audience that you can access all the sessions that were live this afternoon, as well as those on demand for the next 14 days. So do come in and look at those, just the normal way you logged in. Just do that again, and you can come and look at all of those, join the discussion group, which can continue over the next 14 days, and do give your feedback on the conference. That would be very much appreciated. I'd like to thank you all so much for joining us. Thanks for the great questions that came in this afternoon. Really, really good questions there, and it shows a great kind of engagement from you as an audience. And I know it's difficult sometimes virtually, so thanks so much for that. And just joining the Working Capital Conference this afternoon. Thanks to Naresh, our chair for the afternoon, and our other moderator, Brian. And thanks, of course, to our sponsor, PrimeRevenue, who you've just heard from. Don't forget to have a look at their stand, as well as that of the ACTs during the next 14 days as well, because there's lots of materials there, things that you might like to read. Just finally then, watch out for some of our upcoming events. You'll see on screen, we've got our cash management event coming up on the 23rd and 24th of February. 2 afternoons worth of content and lots of on demand that again you'll be able to access after the event if you register now. And our annual conference and International Treasury Week, that is now launched, and there's early bird rates available until the end of February, so do have a think about that one. And yeah, I really hope to see you at these events or elsewhere over the next month as we focus on getting ourselves in good shape for the future, which I think is a bright one for the Treasury community. So thank you once again, take care and see you soon.